Welcome back. Well, 2023 has been a good year for IPO, so let's focus on one such IPO that's coming up. JSW Infra, well, their 2,800 crore IPO opens today for subscription. They've raised close to around 1,260 crore rupees from a good list of anchor investors. The management, well, they're eyeing debt repayment of around 880 crores, though they also have some capex plans. So to understand more about the business, we're joined by Mr. Arun Maheshwari, the Joint Managing Director and the Chief Executive Officer at the company. Hi, Mr. Maheshwari. Good morning, and thanks so much for joining us here on CNBC TV 18. Well, one point that the street would like to understand is, out of your total cargo volumes, how much comes in from the group company? That's the JSW Group.
Well, as on June 23, the quarter ending June 23, it's about 63% comes from the group company.
Looking at reducing
and 37%
this
comes from outside the group.
Are you looking at reducing this exposure?
Well, it has been, it has been continuously reducing because, way back, the genesis of the company started way back to cater to the group captive cargo. Being a process-driven industry, if you see JSW Steel or JSW Energy, way back when we started in 2004, it was largely for the group captive supply chain management control. Till 2018, we were largely into the group company cargoes, and thereafter we started the focus on the third-party development. If you see very closely, 2019 onwards, majority of our investment has been on the third-party business development. It was as low as 6% in 2019 on a 35 million ton volume. In 2023, ending March, we did about 33% of the third-party volume on a 93 million tons of cargo. So the focus, the intention and investment has been very clearly defined, how we are going to shape up this country as an independent vertical.
Got it. All right. Mr. Maheshwari, I just want to ask you and confirm this. Your margins with your larger listed peer is a little bit lower. You're in the mid-50s or thereabouts. They are in 60%, a little more than that. Is pricing at an arm's length with your group's companies, or is there some kind of pricing difference? And do you expect margins to improve from here on?
Well, I would like to differentiate over here the business model, what we have taken for growth and for growing our business. We are largely, we are 50% into the greenfield ports capacity-wise and 50% from the terminal side. When we talk about terminal are the ports given on PPP model in the major ports, which are governed and controlled by Government of India, wherein the ecosystem is provided by them. And we just pay a royalty against that ecosystem where capex is very low. So instead of looking at the EBITDA percentages, we generally go with the return on capital employed. And I think that's our guiding principle whenever we do an investment. So if you see our total building of capacity of 158 million ton, took a total capital of close to about 7,500 crore rupees, which is quite low as per the industry standard. And that's where because of the part of the EBITDA goes towards the royalty, but the return on capital employed remains very robust in this case.
So what's the royalty amount?
It ranges from terminal to terminal. It is as low as 18% and is as high as 52%. But on an average, if I have to look at for our existing terminals, it is somewhere around close to 27%. And when it comes to arm's length pricing, as was asked earlier, yes. I believe we are a well-governed company. Governance structure is very solid and very well in place for all the companies. So being a listed entity like JSW Steel and Energy, they go through a rigorous process. And since still we were not a listed company, we were behaving like a listed company. And we have been going through the similar process at our end as well. And if I have to give a very flair of, a greenfield port, typically a greenfield port in India makes about 60-65% kind of EBITDA margin. Our two greenfield ports are Dharamtara as well as Jaigarh Port. And they also make similar kind of EBITDA margins. So I think it clearly defines, how arm's length transactions are being handled within the group.
Mr. Maheshwari, hi, good morning. So the distinction is important, right?
Hi, good morning.
So basically, between terminals and ports, ports is high capex and high margins as well, as you said, 60-65%. Terminals is very asset light, but margins are on the lower side as well. And you said you look at return on capital employed as a better kind of metric there to assess profitability. Just a quick point, could you tell us, Mr. Maheshwari, what is the total capacity at? And what will it be? If you can, what will this grow to over the next couple of years? And just to try to get a sense of what's the visibility for additional capacity that the group will look at.
Well, if I had to look at today's capacity, it's about 158 million ton. This company is close to about 20-year-old company. And the CAGR on the volume side, if I had to look at it, it has been 22% over the last 20 years. Given the balance sheet what we have, given the appetite what we have, passion and the initiative what the group carries with them for all the verticals, and the opportunity what India offers today in this sector particularly, I think we will be able to try to maintain the similar kind of growth story. Even though the base is very high now, 158 million ton, but our intention is to remain very robust and keep growing on this sector, especially when the opportunities are unlimited over here. Very few players are there in this market today, and because it has a very high entry barrier, the capexes are very high in this sector, and you need a strong balance sheet, and we offer that. And you need to have a good intention to get into this business, and we do possess that.
So, the government is privatizing ports. It's putting up more and more port infrastructure out there for bidding, etc. So there's a large pipeline which will come up for bidding. So you're saying that, so what do you envisage JSW Infra capacity to be, say, 5 years down the line? Where will you be at?
Oh yes, so the great opportunity which comes from the government terminals, because the government is inviting more and more private players to come mechanize, modernize the existing terminals, because government has done their job in the last 6-7 decades. They have done beautiful ports across the coastline. Now they are inviting people because government feels they should be going into the landlord model policy, and wherein they would be charging the royalty for the infrastructure what they have created, for the ecosystem what they have created. Now, people like us who hold quite a number of terminals in India, we are one of the largest in India on holding the terminals. We understand this business better, and we feel that this is a better way to go ahead, wherein the risks are minimal, the infrastructure is provided by the government, part of the infrastructure, the ecosystem is very robust, the customer base is very defined over there. So it is a very good model to grow from here on. And I think we are well suited for that. The kind of terminals we are already holding, the kind of performance we have exhibited in our existing terminals, and the upcoming which are coming up. It is difficult to put a number on the future from the terminal side because it is a bidding process. You bid for the terminals to win it. You win it, you don't win it, it depends upon that. But then pipeline is superb. Like Government of India still owns about 1,400 million ton of total capacity in India, which is more or less 50% of India's capacity. Imagine that kind of capacity is coming up for bidding in even part of it comes for bidding in a couple of 5, 7, 10 years. How many players are there in India today for that?
Correct. Sure. So you're giving us that outlook. That is,
I think we will be able to make it good out of it. Yeah.
Yes, Mr. Maheshwari, we know that there's huge scope out there. That's the broad point that you're making for a business like yours. Final couple of questions before we let you go. One is, how have volumes shaped up in the first half of this year, if I compare it with last year, point number one. And also the group exposure has come down to 63%. Is that a targeted number that it comes down to further?
I'll take the second question first, looking at the group exposure. The way the group is growing, the kind of ambitions what JSW Steel or Cement or Power has, I think it will be very difficult to reduce significantly the group volume, even though we will continue to grow on the third-party volume. I think on a longer-term basis, it will remain 50-50 or 60-40 towards the group side. So I think that would be a robust number, even though however best we try. One good thing is that, for any port company, a solid anchor customer is required. What a better combination than that if your anchor customer is from your own group and which is growth-oriented. Nothing can be a better combination than for any port company. Now, coming to the volume front, on the H1, we don't have the audited figure. H1 is yet to end now. But Q1, our numbers has been 25.42 million tons for this June 23, and which is close to about 10% growth quarter-on-quarter basis, if I had to look at it.
Sir, since your focus is on return of capital employed, that ratio has been going up. In FY21, it was 8.1%. FY22, you increased it to 10.88%, and in FY23, it's at 19.49%. Can you increase your ROCE even higher from current levels? Can it go up to, say, 25% based on the business model?
See, ROC is purely a function how the utilization is happening. So our utilization, like June 23 ending, was about 63%. March 23 year end was about 57%. Before that, it was 45% and 35% and on. So as the utilization goes up, the ROC keeps improving, especially when the capex is already done and only the utilization is remaining for performance purpose. If I had to look at, assuming if the company doesn't want to do anything further and just want to retain with this existing asset of 158 million ton, ROC will keep on increasing because the utilization will keep on going up. So, but given the balance sheet, given the appetite, and given the opportunity in India, I don't think so we are going to stay here. We'll continue to invest and we'll continue to grow this business. So ROC may get a bit tapered down when we go into the capex model, and when the capexes are high, the ROC will tend to go lower. But as the utilization goes up, again the ROC will find its own ground.
Sir, do you have an aspiration in mind? You said the current capacity is 158 million tons. What would the number stand at 5 years down the line?
The way India is growing, I think putting any number to it would be a bit of a challenge as of now. But then I think our ambition is to, remain close to double the numbers in coming years, maybe 5, 7 years or 10 years kind of stuff.
Okay. Well, 1,400 million ton capacity, let's assume 50% of it comes into the market for bidding next 5, 7 years. And there are, as you said, you asked the question, how many players are there? There is, what, 2 or 3, right? You and Adani are the largest.
So, maybe pan-India, whenever you see, there are regional players, but then pan-India players are very few.
Are few, yeah, absolutely. Good luck with that issue, sir. It's great speaking with you, and hope to speak with you again around the time of the listing. Thank you very much for joining us here on CNBC TV 18 with that perspective. That's JSW Infrastructure with the perspective on the issuance.